This is Professor Rujo Moreno with some update on Objective 2 in Chapter 5. Well, like I said, if you need a car, there are only two options. You either can purchase one or you can rent one. Okay. And a long term rental of a car is what a lease is really about. So you're basically borrowing a car. You promise to you sign a contract to promise to keep up with the terms of that borrowing. And at the end, you return it. For most people, leasing a car may not be the best idea, particularly if they drive a lot or they like uh, updating the car with various things, putting personal touches in the car. Um, you can't really do that with a lease. A lease has lots of very specific terms that have to be agreed to, and you have to agree to them. So, in general, what consumers will get is something called a close and lease. They're also called walkaway leases. Simply, you're borrowing the car for a period of time, usually 3 years. And at the end, you simply drop the car off and walk away. Yes, you're borrowing it, you've given it back, and you sort of walk away. That's really important to know. Um, One thing that factors into leasing is the company wants to make sure that if they're going to give you the car, a brand new car, for that matter, for 3 years, they want to be able to estimate as best they can what the residual value of the car will be when you return it. In other words, after depreciation and a little extra fee for wear and tear and usage, when you give that car back to them in 3 years, what's the value of that car? Okay, that's the residual value. So they calculate that up front. All right. And then they break it up into a couple of things. One, they give you a choice of a down payment. Some leases have very low, even no money down as a down payment. Some leases have, you put two, three, $4,000 down uh, on the car. That's part of what the money they need to collect to cover the cost of giving you that car, lending you that car for 3 years. Then there's depreciation. And depreciation can only be calculated if they know roughly how many miles you're going to be using the car. So they usually estimate somewhere between 10 and 15,000 miles per year over the cost of the lease. And thus they know roughly based on that mileage what the residual value will be when you return the car. Okay. If you go over that mileage that's agreed to, that's when they really hit you with a lot of fees. Well, because why? Well, because the car's depreciated more than what they calculated. So they're charging you for that. Okay. Again, you're borrowing the car. You are agreeing to a contract. The terms of the contract are made up with the owner in mind, not you. You're the leasing, right? The owner is going to make the terms of the contract favorable to them. So they want to make sure everything is covered for that. Okay. So a few terms that you'll need to learn about, like capitalized cost, the residual value, the interest rate, which they call a money factor, um, and the lease term. Most leases, like I say, you can get a lease for 2 years, 3 years, 4 years, 5 years, um, any sort of time that you want. But normally it's 3 years. That's the norm. Okay. So your book goes over this idea. The mileage will be an allowance. The reason they do that allowance is because it helps them estimate their depreciation, what the residual value will be based on the mileage, okay, that you put on the vehicle. Because again, you're using up the value in the automobile. That's what depreciation calculates. So that's why there are strict limits on the mileage. And if you go over those limits, you're paying really an arm and a leg for each mile you go over that. At the end of a lease, you can just drop it off. That's what a close-end lease, the benefits of that. Just, it's done. They inspect it, make sure there's nothing additional, and then you're done. You're done. But some come with a purchase option. So at the end of the 3-year period of time, you have an option to buy it outright, buy them outright. And so that's what this is. One of the biggest problems with the purchase option is oftentimes people are not negotiating on a leased vehicle. People negotiate price on a new vehicle all the time, even used vehicles. Yeah, I'll give you this much for it. They tend not to do that with a lease. And so auto dealers make a pretty good amount of money from leasing their fleets. And that's because you're paying virtually full price for a vehicle, particularly if you buy it out at that option price. So the best thing to do if you're very interested in a lease is to negotiate that price. If you're looking to have the option to purchase, and simply an option, it's not a requirement, it's an option to purchase, you'll be getting a good price for the vehicle. Okay. One thing that's looked at is, why even bother leasing a car? Well, leases are good if you don't, if a few things matter to you. Number one, you like having the newest cars to drive all the time because you're going to be getting a new car every 2, 3, 4 years, right? Two, you don't drive that much because of those mileage requirements. If you drive lower than that, then lease is a viable option for you. Um, if you have a business and you can write off the lease payments and automotive expenses, that's a decent option for you as well. Yeah, there's lots of different reasons for it. Again, when you're leasing a car, you're simply borrowing it. So usually the dealer want to make sure you're keeping good track of it. There's required maintenance and other types of things that you've agreed to, and so those cars do tend to be cared for pretty well. Okay. One thing that is given here is a worksheet that you should sort of understand. It's good to think about if you're considering a lease or a purchase. Here we have this idea of Abigail wants to buy a Prius for $29,990, and she has two options. She could buy it outright, but it's going to require a $4,500 down payment. She's going to have to pay sales tax in this scenario 5%, and she'll need a 48-month loan. If she leases it, she's also going to be required to put down a down payment and a security deposit, and then she'll have her monthly payments for this. And so this goes over, the first thing is, what's the cost of the lease for Abigail? Well, she's got to put down some money up front, $3,400 up front. She's going to have this for 4 years, so it's a 48-month lease. That's $440 per month for 48 months. So she's going to be making over $21,000 of payments just on this particular lease in addition to that, right? Well, the opportunity cost of putting that down payment down would be losing 0.03% interest on the money, which over 4 years is $408. So in total, she would have to fork out a total of $24,408 as a total cost of her lease. If she bought the vehicle, assuming she didn't negotiate the price, she would have to put a down payment down, she would have to pay sales taxes, and then she would need a loan for the difference for 48 months at 4%. So she would end up paying over $27,600 in payments in addition to the down payment and the taxes. The opportunity cost is she would be losing out on 4 years of interest on her down payment, which means she would have given up a full $540 in opportunity cost money there. But at the end of the 4 years, the car is valuable to her. She'll still have $16,500 of value in the car. So when you take all the money she's going to be forking out and subtract out the value of the car at the end of that 4-year period, it is going to cost her money, but not as much as the price, right? It's 17,660 something, which is smaller than the cost of leasing. So, based on this analysis, she should probably buy the car. All right.